Hey everyone, welcome back to Corporate Decoder, the place where we sift through the corporate paperwork so you don't have to. Today we're diving into Webster Financial Corporation's latest filing. Get ready for a roller coaster because this report has some interesting ups and downs, almost like they flipped a coin to decide what happened. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below if you have any question about this report or want to discuss investing. Webster Financial, a big bank holding company with over $80 billion in assets. Their core business is in the Northeast, offering banking services to businesses and consumers. So what's the story this quarter? Basically, they made a bit more money compared to last year, but some of their key businesses are facing challenges. Let's get right to the numbers. Net income is up about $10 million, landing at $226.9 million. That translates to diluted earnings per share of 123 thanks last year. So a bit of a win there. Their return on tangible common equity, a key measure of how well they're using their capital, dipped slightly to 15.93%. It was 16.30% last year. It is still very high, but the trend is important to look at. Now, for the not so great news, their non-performing assets, those loans where people aren't paying, have almost doubled, jumping to $564.7 million revenue from $289 to revenue, and could potentially result in losses. To prepare for potential losses, they've also increased their allowance for credit losses, that is ACL on loans and leases. It's now 1.34% of total loans, up from 1.26% last year. So they are expecting more losses. Now let's dig into where their money is coming from. Their net interest income, the difference between what they earn on loans and pay on deposits, increased by 7.8% to $612.2 million. But here's the catch. The average yield on their interest-earning assets actually decreased, while the average rate they paid on interest-bearing liabilities also decreased. This means they're making more money on volume, not necessarily on better rates. This could make their asset less attractive as the market changes. Moving on to non-interest income, which includes fees and other services, that actually decreased by almost 7% to $92.6 million. Deposit service fees, those pesky fees you might get for certain bank transactions, were down almost 9%. That's likely due to a combination of higher revenue share costs and lower customer account service fees, but it's partially offset by higher ATM surcharges. In a volatile market, trading securities can be risky. They swung from a nearly $10 million loss last year to a small gain this year. In the first quarter of last year, they sold more securities than this year. Let's check where the money is going. Their non-interest expense, the cost of running the bank, increased by about 2% to $343.6 million. Compensation and benefits, what they pay their employees, jumped by 5.44%. This reflects the investments in human capital as well as employee benefits. It goes hand in hand with a smaller team. The cost of deposit insurance, thanks to the FDIC, decreased almost by a third. That's mainly because they had to make a big special assessment last year. Now they don't have that cost. To understand which of Webster's business is doing well or not, they break down their performance into three main segments: commercial banking, healthcare financial services, and consumer banking. Let's start with the bad. Commercial banking's pre-tax, pre-provision net revenue decreased more than 10%. That's a lot. This is driven by lower loan yields. Translation, they're not making as much money on each loan compared to last year. Healthcare financial services is on the opposite side with increased revenue. Their net interest income is up because of higher deposits and an increase of HSA and Amatros accounts. Consumer banking is showing the same trend as commercial banking, with decreased revenues due to lower loan yields, as well as the net gain on sale of mortgage servicing rights in the first quarter of 2024. That is not present this year. They've also spent more on technology investments. Zooming out to the whole company, total assets increased a bit, but that increase is attributed to decision to hold higher levels of cash. Investment increased and deposits increased. The increase in deposits was offset by increases in Federal Home Loan Bank advances and a decrease in agreements to sell securities. The change in mix of these liabilities does not reflect well on their sales. Webster invests in debt securities for liquidity, interest rate management, and income. These investments are classified as available for sale or held to maturity. Their available for sale securities are up almost 4%, and their held to maturity securities are down. Held to maturity assets aren't usually sold. This means they're selling some of their assets. Webster mostly does commercial non-mortgage loans, commercial real estate, and multi-family loans. A significant portion of these borrowers or properties are in the New York City area, so they better hope rent gets paid on time there. Their non-performing loans where people aren't paying, are up. Their ACL also increased, so they see it too. As a bank, it's important that Webster has enough money to meet its obligations, and regulatory agencies also want to see a good picture of their capital. The holding company, the parent company, mainly gets its money from dividends from Webster Bank, the subsidiary. The holding company uses the money to pay shareholders and buy back stock. They do have some restrictions on the bank's payment of dividends to the holding company. The dividends to shareholders remain the same, so shareholders can be content about that. However, the board of directors can decrease those at any time. The bank's liquidity is primarily their core deposits from their customers, and also they can borrow from the Federal Home Loan Bank and the Federal Reserve Bank. The most important part of the filing, in my opinion, the company has to be well capitalized, that is, have some safety net to avoid going bankrupt. Basel III, which are some global standards for banks, requires the company and the bank to maintain minimum ratios of CET1 risk-based capital, Tier 1 risk-based capital, Total 1 risk-based capital, and Tier 1 leverage capital. Translation, they have to have a minimum percentage of common stock and other things to avoid going bankrupt. At March 31, 2025 and December 31, 2025 and December 31, 2025 and December 31, 2025 and December 31, 2025, both the company and the bank were classified as well capitalized. So they are fine here. The amount of fluctuations, what happens with interests, rates up and down 100, 200, and 300 basis points, is relatively stable from December last year. The CEO and CFO certified that their financial reporting is solid. There were no issues in the last quarter, but these things can't catch all errors or fraud, because things can't catch all errors or fraud, because things can change or things might be missed. Webster seems to be navigating a changing economic landscape. Their non-performing assets are a significant red flag suggesting potential trouble with loan repayments. Management have said, yeah, we see the increase by taking precautions and increasing their ACL, that is, expect losses. It is really important that in the future they find a way to improve loan yields and look for better loans to give. Alright, that's our breakdown of Webster's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more conversation. Thanks for watching. See you next time.